Hello. Today's keynote speech is going to focus on leverage. And to start the speech, I will now share my screen. All right, so the paper I'm going to present is called Leverage is a Double-Edged Sword. Okay. So this is how the speech is going to proceed. Let me try to motivate the paper. Essentially, the paper is about the issue of leverage. Leverage, as you know, magnifies gains and losses. For example, if a stock has gone up and somebody has bought the stock on leverage, like Tesla, they're going to magnify their profits, right, because it went up. On the other hand, had it gone down, they would have magnified their losses as well. And for example, the Wall Street Journal says that this particular trader made a lot of money using options, which essentially are levered positions in the underlying stock, right? So there are other cases in the popular press where people have talked about how leverage essentially causes a spectacular failure of financial firms. In this particular case, that firm, Archegos Capital Management, failed pretty much because Bill Huang essentially took on a lot of leverage and magnified his bets many times over. So the question that arises is, well, what exactly do you do to get a leverage? Well, you can get leverage directly by borrowing from a bank, but you can also take positions in securities like options and futures, which essentially end up giving you leverage. Right? And so there are many such cases where people have taken on leverage in one form or the other and experienced spectacular losses. And we've seen such cases in the popular press. But the question that arises is, how does leverage affect a trader's performance in the cross-section? That is to say that when people take on leverage, is the effect of that leverage uniform across investors, or do some traders get hurt and some traders get helped by leverage? So what we're going to do in this paper is to use high-frequency account-level data for futures markets to quantify the effect of leverage on performance, and also reveal the sources of profits or losses for traders that do take on leverage. That's the basic idea. So essentially, it's a study of the topic on a more cross-sectional level, that in a large sample across investors, what's the effect of leverage? So just to make sure that we understand the focus, our focus here is on implied derivatives leverage. We don't consider borrowing from a bank to take on leverage. It's just that when you take on a derivatives position, it's like a levered position in the underlying security, right? So we're not interested in loans, and so the loan interest rate is not relevant to our analysis. And we're going to measure implied leverage by the amount of notional spot controlled relative to the cash invested. That is to say, on a given day, given your position, what's the implied leverage of that position and how does that affect your performance? So in terms of what questions we might want to answer, suppose we can divide up investors into skilled and unskilled, right? Some investors are skilled, some are unskilled. We know that unskilled investors might gamble in stock markets or trend chase, chase past performance. And so the relevant question is, well, what's the role of leverage in these types of behavior? On the other hand, skilled investors might do informed trading. They might have privileged information on which they trade. They might do de facto market making, which means they provide liquidity. They buy when others are selling and sell when others are buying, and provide liquidity to the market. Or they might do arbitrage between a derivative and the underlying security. Okay. So the question that arises again is, what role does leverage play in these activities? Right? So another question that we can address in this paper is, if people do underperform in markets, there could be two reasons for it. One is they simply trade too much. That's something the literature has already shown, that people trade too much. There's an inverse relationship between how well they do and how much they trade, right? And the other thing that's unique to derivatives is essentially margin calls. So when your leverage becomes too high, then people can say that you need to make good on your margin, and if you don't, then we'll close out your position. That particular aspect called margin calls, where the margin drops too low in your account, is unique to derivatives, right? So the question that arises here is that what is the relative role of overtrading versus margin calls? And that's also something that we can speak to. Okay, so let me move on directly to the data. So our data is provided by a major futures broker in China and spans the period given on the slide. The advantage of this data is that it's essentially consists of orders, transactions, and holdings for every investor in the futures market. And it also includes cash flows, profits, how much cash was injected on a given day, and how much cash was withdrawn. The important thing is the data is timestamped, so it tells us when exactly the order was actually submitted. And there's a large number of investors. Some of them are institutions, quite a few of them, and there's a large number of trading records. And the notional value traded is extremely high, 8.9 trillion CNY, more than a trillion USD, obviously. And there's a lot of futures contracts. And the positions in all contracts are marked to market daily, like the United States. It's the same idea. Okay. Now, before we get into the data analysis, the first thing I'd like to point out is that on net, investors lose money in this market. 1.05 billion yuan is lost, and the average capital loss is 93,000 yuan. That's going to be compared to the Chinese GDP on per capita basis of 64,000. So people really did lose a lot of money in this market. Okay. That's not really our focus. Our focus is to actually look at the cross-section of traders and relate their performance to leverage. To that end, let me just show you a few quantities that we're going to compute that will help us in our analysis. The first thing we have is a measure called daily rate of return, which is essentially the daily profit in percentage terms for a trader I on day T. And that's basically the numerator is how much money you made in the futures market, daily profit, divided by how much cash you put in, but what your asset value was on the previous day. Okay. So the denominator is simply the total amount of cash you staked, right? And the numerator is simply how much money you made across all contracts. Then we also have something called daily turnover, which is essentially how much you turned your portfolio over, defined in a similar way. Okay. So DTO is just simply how intensely you trade. The other measure that's critical to our analysis is DLV, daily leverage, which is essentially the maximum value controlled on a given day relative to cash at stake. So the maximum value held, which is the numerator of DLV, is simply the maximum amount you controlled on that day, right? So that's the definition. Maximum value held is the max of notional value across all the trades that the investor did on a day T. And the max simply means what is the maximum value you controlled, divided by the cash injection on that day plus the day-end asset value on the previous day, which is simply the cash at stake, right? So if DLV is high, it means that you took on a lot of leverage, in fact, right? So that's the idea. And so just to define the notional value, it's simply the number of contracts times the price. Now the price we measure as of the previous day rather than on that given day. And the reason is that there's otherwise simultaneity when we measure performance on a given day and the price on a given day. So just to avoid that issue, we measure the price on the previous day. Okay, that's the only thing to note here. But we do have robustness checks with the contemporaneous prices that we call DLV. We also look at DLV on the previous day with the previous day's contemporaneous price. We also look at a predicted DLV, which is the DLV based on a AR4 prediction on a given day using all historical data. The results are basically similar for all these measures, so we're not going to have much to say about that. We're simply going to use our base DLV measure throughout. We also have a procedure by which we identify skill versus luck for investors. So we identify these using something called the Fama-French 2010 procedure, where we compare their actual profits to what would have been achieved in a simulation, via a simulation, which essentially says that if you just got, lucky, what would it have been, as opposed to what it actually was. And the differential between that is what we call skill, right? So if that differential is sufficiently high, we classify them as skilled. And if that differential is sufficiently large negative, then we classify them as unskilled. That's all I can tell you in this case, in terms of what we do. But basically, the idea is that we stratify investors by skill, skilled and unskilled. Okay. And one more important thing to note when we do the skill analysis is that the skill is identified in the first sample year, and the performance by skill is analyzed in the latter sample year. So we have 3 years of data. The skill is going to be identified in the first sample year, and the performance by skill is going to be analyzed in the later sample years. Okay. Just to give you a feel for how DLV looks like, I mean, DLV ranges between, on average, 17 for the traders with the top 1% of DLV to just 1 to traders in the bottom 1%. You can also see in terms of TTO, the traders with the highest DLV are also the most active traders. Right? That's all that we need to note here. And in terms of the cost, right? Traders with the highest DLV also have the highest brokerage commissions, which is what the cost represents. Now let's talk about basics of risk and return. So first of all, I'd like to point out that if you simply look at the standard deviation of the gross DRR, which is the daily return rate of return, then DLV is positively related to volatility, which is not surprising because if you regress volatility on leverage, you get a positive coefficient, which is what we do. Okay. We also have a dummy for institutional investors in this regression, where the dummy is 1 if it's an institution, and we interact institution with DLV. But we don't find that DLV has an incremental effect for institutions on volatility. But volatility of a trader's return is significantly related to DLV, which is pretty much intuitive. So the question that arises is that people with leverage take on more risk because the volatility is higher. What about the return? Well, it so turns out that leverage has a negative impact on DRRs. And so if you simply plot the negative of DRR on a 3D plot vis-a-vis DTO and leverage, DLV, so leverage quintiles or turnover deciles, then you see that except for the top left bar, everything is positive. So I mean, most traders lose money, except for one group with the very high leverage and very high turnover, which earns positive. Remember, this is minus gross DRR. So positives mean bad performance. Okay. So only in one case do you see actual good performance. We'll come back to that case in just a bit. And so net DRR is not positive for anyone. Net of commissions, that is. Net DRR is just net of commissions. Basically, everyone loses money. So that's the takeaway from this. If I simply run a regression of post DRRs on DLV, I get a negative coefficient. And the notion is that leverage hurts gross returns. Okay. And leverage hurts net returns too. So on aggregate, we get a negative effect of leverage on returns. That's what we find here. So this is what I just showed you. Nothing new here, right? So the one question is that leverage is supposedly an amplifier for portfolio returns. So if it increases volatility, it should also increase returns. But why does it reduce performance? In other words, it should have no impact on performance, even if it doesn't decrease, for example. If people really know what they're doing, then leverage should increase performance, right? If it uses volatility, because you take on volatility to earn a higher rate of return. But if people have neutral skill, that have no skill, then it should have symmetric effects, so it should have zero impact on returns. But it actually reduces performance. So why is that? So one reason might be that there's forced liquidation events in the futures market, because when your margin drops too low, then brokers can make a margin call saying, put up more money, and if you don't respond in a certain period of time, they can close out your position, which is essentially a forced liquidation event. Right? And if you have more leverage, you're going to have an increased likelihood of forced liquidation for the reason that that's essentially what high leverage does. It reduces margins, right? So what we're going to do is that we're going to define a dummy called force, which is 1 for an investor day when forced liquidation occurs, and include force as an independent variable in the regression. And what we find is that force has a huge negative impact on gross and net DRR, performance that is. And it is in fact quite big, right? So that liquidation event has a big impact. And just to give you a feel for the magnitude, that the coefficient without force dummy is minus 3.3 on gross DRR, and with force it becomes minus 0.61, right? So it reduces. For net DRR, it's minus 5.35 without force and minus 2.67 with. So on overall, if you look at the net DRR, about 50% of the leverage effect on net DRR can be explained by force liquidation. The remaining part is explained by the increased commissions due to leverage-induced trading. And this shows you the liquidity cost around forced sells, because when your asset is liquidated against your will, then you pay liquidity cost. And this just quantifies the liquidity cost in terms of doing an event study around the return in basis points around the forced sell. It's like a fire sale, basically, at day 0. Okay, so now the next question that arises is, when you divide up traders into skilled and unskilled, what kind of results can you get? So the first thing I'm going to show you is that the tendency to gamble on the part of unskilled investors has been shown in other contexts. So in this context, we show you that by saying that traders do gamble, and leverage has a negative impact on the gambling induced underperformance. So let me explain how. We define a quantity called amplitude, which is the high of the asset price when it's the low of the asset price over the close on the previous day. So when amplitude is high, then it means that the asset is very volatile that day, right? So if you're a gambler, then you want to trade more in high volatility days. Then we also define in this regression something called the high DLV dummy, which essentially is 1 if the trader is in the top quintile of leverage. Okay. So the AMP, as you can see, the amplitude has a negative impact on net daily return and a positive impact on turnover. So amplitude hurts performance, which means that people like to trade more in high volatility days, and they lose money as a result. They also trade, right? So the turnover means trade more. The negative on AMP means they lose more. Now, the interaction dummy of high L with AMP is actually negative and significant, which simply means that the tendency to trade more on high AMP days implies negative performance. And when you're levered, it implies a bigger impact, right? So leverage hurts gamblers in the stock market, in the futures market. We already know it hurts them in the stock market based on earlier research. What this is saying is that leverage hurts gamblers more in the futures market. So that's that. Okay. And so now let's talk about skilled investors. Now, there are 8 skilled investors in the sample, which do really well. And if I simply take a look at their gross DRR versus leverage and turnover for the skilled investors, you can see that most of the traders that do really well are essentially traders with basically high turnover and high leverage. So when you have high leverage and high turnover, you do really well, right? So that's the basic idea, right? So this is basically a plot across all investor days just for the skilled investors. Okay? And all this is saying is that if you're skilled, then you make money when you trade more on high leverage. Okay. And so all this is saying, and this regression is saying, is that if I simply take the skilled investors and define them to be as a dummy, right? Then leverage for the top, the skilled investors, essentially helps the performance. Even though on average, leverage hurts performance, negative and significant coefficient on net DRR. For the skilled investors, which is a top dummy, you can see that leverage actually helps. So now let me tell you exactly what these skilled investors are doing to take advantage of leverage. So what they're doing is that if you look at the order imbalance of the skilled investors, which is OIB, OIB is just net buying pressure. Order imbalance, which is buying minus selling, the net buying pressure, a scaled version of that. And what we're seeing is that their order imbalance is essentially positively related to future returns for the next minute and next 1 to 5 minutes, but it's negatively related to past returns, right? Essentially. So what this means is that they're essentially buying after a dip and selling just before a rise, right? So they're kind of timing their entry into and out of the market. Because essentially what's happening is that their OIB is positively predicted returns before the rise, right? And negatively after a fall, right? So they're essentially timing their entry into the market, right? That's essentially the story. So if you take a look at the following, that if you define 0 as the day on which they open a buy position, that's the blue circles, then you can see that after they open a buy position, the price rises, right? Now, if you look at the purple, that is when they open a sell position. And you can see that if you define that as time 0, then after they open the sell position, the price falls. Right? So they kind of have the ability to predict predict where it's going to go. And it looks like what they're trying to do is that they're trying to buy on dips and sell just before fall. So they're kind of timing their entry into the market effectively. All right. So what we've shown there is that unskilled investors lose money via gambling, and leverage exacerbates that. Skilled investors are able to time their entry into the market skillfully, and leverage helps that. To actually nail this down more, we do an event study around regulatory shifts in margin requirements. So what the exchange did was that they essentially, to curb excessive speculation, they raised the margin ratio requirement for futures return on 16 underlying commodities. And so what we're going to do is to do a differences around the margin ratio requirement. Here's the result of the difference in differences analysis. The event window is between April 5 and April 29th of 2016, which is essentially when the margin ratio requirement was increased. And so in this case, the treat is basically those people whose average DLV on 100 to 1 day before the start of the window was higher than the median. So I had high DLVs. And then the observations used are just given to you there, with 100 days before to 100 days after. Okay. So in differences, we are mostly interested in street star after, which is that how well the traders with high DLV do after the margin ratio change, right? So we can see that their DLV went down, right? Okay. But interestingly, their DRR went up or become less negative. Okay, and so the idea is that leverage hurt them, but restricting the leverage via the high margin ratio actually protected them, right? So it increases the return, right? And it reduces the volatility, which is the last two columns. The standard deviation of DRR goes down, right? So it's protective. Now, here's the interesting thing, okay? If you take a look at unskilled investors, the pattern is similar. At the margin ratio changed, increased their DRR, and was generally protective. But for skilled investors, it's the reverse. Institutions taken together, it was the reverse. So what happened in this case was that treat star after was negative and significant in two cases, which essentially means that in this case, the DLV did go down for these skilled investors and institutions, but the DRR also was negatively impacted. There was no impact on volatility, but the DRR was negatively impacted. So the key point here is that the opposite signs of the coefficients were unskilled and skilled. So the margin ratio requirement had a positive impact on the DRR of unskilled investors. It protected them, but it had a negative impact on skilled institutions. So people who are really skilled at trading, it actually hurt them. That's the takeaway from this. So in conclusion, what we do in the study is that we studied the effect of derivatives leverage on investors' performance using a knowledge brokerage data from a broker in China in futures trades. And so what we find is that for skilled investors, leverage boosts returns via market timing. Okay. For unskilled investors, leverage amplifies losses due to gambling. So unskilled investors gamble in markets and leverage magnifies it. Skilled investors are able to time their entry and exit in the market effectively, and leverage hurts them. Right? And for the majority, however, leverage reduces performance and makes returns more volatile. And much of this reduction in performance is explained by margin calls, which happen when brokers call you to put up more margin, and if you don't respond, they close your positions. And so leverage is like a double-edged sword, right? And we will confirm that with the difference in differences, where we show that the restriction, which sort of increased margin requirements, helped the unskilled, but hurt the skilled, right? So what we're saying here is that regulating or restricting leverage should be approached with caution. So you can't say leverage is bad, so let's regulate it. Because there are many people who actually are skilled enough to provide liquidity to the market. They're buying low and selling high, right? And if you hurt them, then you might hurt the liquidity of the market. So that's essentially the point, that regulating should be approached with caution, that leverage does not have a uniform impact on investors. So regulating leverage can have differential impact. It might hurt the skill that provide liquidity to the markets. And that's all. So that is the end of my speech, and I'm going to stop now. Thank you.